Hey traders! Ever noticed how in Forex, price doesn't always move in a clean, step-by-step way? Sometimes it just rockets up or down, leaving gaps behind. One powerful concept used by smart money traders to understand this is called FVG, or fair value gap. Today, we're breaking down what it is and how you can use it. So, what exactly is a fair value gap? Think of it as an imbalance in price that happens when the market moves too quickly in one direction. It's a three-candle pattern. You have a first candle, a big, impulsive middle candle, and a third candle. The FVG is the space left between the wick of the first candle and the wick of the third candle. This gap shows an area where price moved so fast that it skipped over a fair valuation, creating an inefficient price run. There are two main types of fair value gaps. A bullish FVG forms after a strong, explosive move to the upside. You'll see it below the current price. Conversely, a bearish FVG forms after a sharp, aggressive drop. This gap will appear above the current price. Both types signal a powerful one-sided move that has left an imbalance in its wake. So, why are these gaps so important? Well, markets hate inefficiency. They have a natural tendency to return to these fair value gaps to rebalance price and fill in the missing orders. Think of it like price revisiting an old area to pick up unfinished business. This rebalancing act makes FVG zones powerful areas of interest for us traders, because they often act as magnets for price. This is where it gets exciting. Traders use FVGs as high probability entry zones. For a bullish FVG, you might look to enter a long position when price dips back into the gap. You'd place your stop loss just below the gap and target a new high. For a bearish FVG, you'd do the opposite. The key is to always align your FVG trade with the overall trend, market structure, or your higher time frame bias. Now, a word of caution. Fair value gaps work best when you combine them with other technical factors. This is called confluence. Look for an FVG that lines up with a break of market structure, a liquidity grab, or happens during a key trading session like London or New York. Never, ever trade FVGs in isolation. Context is everything. A common mistake beginners make is trying to trade every single gap they see. This is a recipe for disaster. Not every gap is a high-quality, tradable setup. Professional traders are patient. They wait for price to not only enter the FVG, but also show some form of confirmation, like a shift in momentum or a smaller time frame entry pattern, before pulling the trigger. To wrap it up, fair value gaps reveal where the market moved inefficiently and is likely to return. By learning to spot them, combining them with other powerful concepts, and waiting for the right context, you can start to understand and trade more like smart money. Thanks for watching. If you found this helpful, be sure to hit that like button and subscribe for more trading content. See you in the next video.